Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday. It's January 19th. Happy Friday to you guys. I hope you guys got some great upcoming plans for the weekend. We got the NFL, AFC, NFC championships, so some good games, upcoming games here. Looking forward to that on Sunday. Hey, we do got just one economic news to go over today, so we'll jump right into it, and we'll start off with the consumer sentiment for the month of January. So our previous reporting was at 95.9. The forecasts were to go up at 98, but it dropped a little bit, 94.4. So that's kind of a curious one, especially after the tax thing. You'd think that would get people feeling a little bit better, but maybe they're just getting a little worn out from the holidays and they're feeling a little bit down. Hard to say, but let's see how that what trend that moves towards next month, the next reading, see if it improves or not. Headline news: stock market is mixed. The Dow's the only one that's down a little bit for the day. So we got Q4 earnings reports all looking pretty good, but the big thing is the possible government shutdown. Now the House passed through a possible resolution, but there is some question if it will pass through the Senate. So we need it to pass through the Senate uh, and be able to get moving forward. And I think it's just more of a 30-day type of deal here, kind of like what we've been doing, where they've been kind of kicking the can down the road, so to speak, versus a long-term plan here. But uh, at least hopefully it'll avoid a government shutdown. They have until midnight tonight. You'll probably see this on the news quite a bit today. So there is a little uncertainty there. Now, they say that if there's a government shutdown, how it affects the economy is that it costs about $1 billion a day that the government is shut down. So that's quite a bit of money, and it could be a pretty big hit to the economy, even though we're in the trillions of dollars. But every little bit helps. So let's kind of take a look, see how this is affecting the bond market. Bond market is in the negatives again. We're about minus 6 basis points. Not quite enough really for a worse in pricing, but if you look at the Treasury, we are up against that resistance that we have been talking about, the 2.635. Right now we're at 2.637. If it breaks above that and stays above that, this could push rates further up higher, further in negative territory in the bond sections, which would create higher interest rates. So, because it happens, the next round up is pretty high, and it would wouldn't be good for bonds or mortgage-backed securities. That would also could potentially hurt stocks as well, primarily because if you listen to yesterday's reporting, with these higher yields, these are less risky and may pose to a better investment vehicle for some of these stocks. So they may pull money out of stocks and put into these yields since they're at a high rate right now. And they might be comfortable with that at less risky, getting a good rate of return at less risk is how they'll look at that. So especially with stocks kind of reaching a riskier point with continuations of market highs, they may start doing that. So just be cautious in that area as well. So let's hope that this holds. This has held this down for quite some time. We haven't really been above this, and we've knocked down it like last 4 years or so. It was like knocked down a couple of times, and each time got knocked down. But again, we're in different territory. We're in a rising rate environment, and this could potentially, you know, hurt both stocks and mortgage-backed securities or interest rates. All right, so that pretty much wraps things up. Rates are about the same as where we left off yesterday. But if you guys want to get more updates, just go over to Twitter. I do post throughout the day on Twitter. You can find me at Mike Bjork on Twitter. And hope you guys enjoy the rest of your day and weekend, and look forward to see you guys on Monday. Thanks so much for watching. Bye-bye.